Inflation is down, but debt servicing ratios are up. A lot of Canadians are feeling the pinch, and yet the government keeps telling us that everything's fine and that our economy is doing great. However, it's only when Trudeau and the Liberals are really feeling threatened with their position in power that we start to see all of a sudden huge swinging broad changes in our mortgage regulations and lending practices to encourage more debt, all while we have the Bank of Canada telling us they're loosening rates because inflation has gone down, but they're actually using data from mortgage rates to calculate CPI, essentially creating a circular feedback loop on what inflation actually is. So what can we expect moving forward with all of these changes, interest rates coming down, and regulation loosening around lending? Is the government simply stimulating our economy, and is this going to push housing prices back up a little bit too aggressively? Let's get into it. Hi, my name is Adam Nadler. Thanks so much for tuning in yet again. If you haven't yet, feel free to hit the like button on this video if you find value in this content. And don't forget to click the subscribe button right below this video so you can join our community. If you have any questions about real estate and you'd like to chat, please use the first link in the description below. That'll connect you to a calendar where you can chat with me at a time that is most convenient for you, or feel free to just shoot me an email with any question you have to adam@visionrealestate.ca, and I will send you a custom video response within 24 hours. All right, so let's start with inflation. We're not seeing it in headlines anymore, and that's because it's come down. However, if you really dive deep and unpack what they're actually saying, our CPI calculations are deeply flawed and highly politicized. One thing that most Canadians aren't even aware of is that when we calculate inflation in Canada, we're actually using mortgage rates to do so. Canada uses a circular inflation model where rate decisions directly influence inflation. Canadian inflation declined so rapidly partially due to the circular nature used in reporting. StatCan includes mortgage borrowing costs in its basket, which are largely influenced by the Bank of Canada key interest rates. This leads to upward pressure in CPI when the central bank raises rates and lower pressure when they cut rates. It's a self-serving loop, resulting in the central bank's decision being a key component in the direction inflation moves. This isn't the norm in other advanced economies. For example, the US doesn't include the cost of mortgage interest, arguing it would be silly to have a circular feedback loop that doesn't accurately measure the cost of current consumption, which CPI is designed to measure. Instead, including the cost of borrowing reflects the contracted cost of consumption today, but not necessarily a real cost that will be incurred, either through refinancing or selling early. Basically, we have a highly politicized basket that we're using to calculate inflation, and this is contributing to the Bank of Canada loosening rates, and arguably maybe even a little too aggressively. According to the Bank of Montreal, Canada's key vulnerability is debt. When compared to our neighbors in the South, the US had a massive deleveraging happen in 2008. When they had the financial crisis, which we largely didn't really experience in Canada. As a result, our debt servicing ratios are sky high. Canadians love mortgages, and we take them on with as much vigor as we can possibly handle, driving up sales prices. And ultimately, it's led us into a very real concern when it comes to GDP per capita. Compared to our neighbors in the South, we're not actually improving our current living standards. We're not making really any money. We have a huge productivity problem in Canada. And this didn't seem to really bother the government until it seemed their grasp on power started to slip. And then as soon as we saw the NDP tear up the deal that they had to keep the Liberals in power, the Liberals immediately started loosening regulations in Canada, most notably raising the cap on insured mortgages from $1 million to $1.5 million and removing the stress test for those who are refinancing and moving to another lender. Combine that with interest rates moving lower and lower, this is a recipe for the market to start to turn. When it comes to housing, we're seeing that reflected in sales volume. It is increasing. Year over year, sales volume is up 8.5%. And just month over month, it's already up 3.3%. Now, selling prices, though, haven't really moved. Average price is about the same. However, that's because we saw total new listings hitting the market almost equal the increase in sales volume. New listings are up 10.5% year over year, but the sales to new listings ratio didn't move at all. So this has stagnated price for now. Overall, it seems we are in a slower market, but consumer confidence is quickly returning to it. Ultimately, this may just reveal another bubble situation where we have spikes in prices followed by crashes again and again as we inch our way forward throughout the next few years. And I don't think this is a necessarily good thing for our market. However, the government is throttling down with full steam ahead on encouraging consumers to take on more debt. So yes, it will take a little bit of time before we start seeing real estate prices start to really increase. But ultimately, when you look at the ingredients that we are concocting in this economic potion, it's definitely going to come. But hey, that's just what I think. Let me know what you think in the comments below. Thanks so much for tuning in again, and I'll see you next time.